Now, just days to go before a review into the Reserve Bank is handed over to Treasurer Jim Chalmers, the RBA board is also considering a halt on interest rate rises. If they do stop the consecutive interest rate rises, then they would be sparing mortgage holders from an 11th consecutive hike. We don't know whether enough has been done to tame inflation. My next guest knows the ins and outs of this more than most. Warwick McKibbin served on the board of the RBA from 2001 to 2011. He also worked at the Reserve Bank from 1975 until 1991. He still, to this day, advises international institutions, central banks, governments and corporations. Warwick McKibbin joins me now from Canberra. It's great to have you with me. Now, the US, we've seen, has raised rates again despite concerns that this could add to financial turmoil. Warwick, do you think central banks should be pausing aggressive rate rises at this point or continuing to tame inflation?
Hi, Sharri. It's good to be on the show. I think there's two separate issues here. One is central banks should be focusing on inflation. Inflation is high around the world for various reasons. Interest rates need to go up to deal with that inflation shock. At the same time, we understand there will be financial instability. And so the financial parts of the Fed and the other regulatory agencies need to deal with the financial instability at the same time, but using different instruments. And so I think it's important, if inflation isn't tamed now, the cost to the economy and to low-income individuals would be far worse than the impact of higher interest rates for a shorter period of time.
So you think, again, that Australia's RBA should follow the US and continue to raise rates?
Or not necessarily follow the US. We should look at the situation in Australia. If the situation in Australia is inflation's running at 6.8%, the policy interest rate is 3.6%. That makes real interest rates very, very negative, which is very stimulatory. So independently of the rest of the world, Australia should be raising interest rates to try and slow inflation. What's important, though, is the impact of interest rates isn't just through mortgages. One of the most important impacts is through the exchange rate. When you raise interest rates, the exchange rate goes up, imports become cheaper. That's an important inflation channel. If the rest of the world is raising interest rates, as the Fed did last night, that makes the Australian dollar cheaper, which will make imported goods, both intermediate goods as well as final goods, more expensive. And so that's going to add to the inflationary shock. So in both cases, whether you're focused on what's happening in Australia in terms of excess demand and what's happening in the rest of the world through central banks raising interest rates, we have to raise our interest rates. We should have an interest rate well above where it is right now.
Well, on that point, you say we should have an interest rate much higher than it is right now. Are you critical that the RBA took so long to really start raising rates in 2022? I mean, we're lagging behind the rest of the world. They were really on the back foot.
Well, it's easy to make the argument in hindsight, although I must admit, I was on the shadow RBA board.
We could see inflation was rising, though, a year ago.
Well, we could see nominal growth was actually rising more quickly than inflation was. The RBNZ, through Central Bank in New Zealand, actually saw this and started raising interest rates about 3 or 4 months before Australia did. So if you're looking at the right thing, which was nominal growth, you would have acted more quickly. If you're looking at wages or you're looking at CPI inflation, that's not necessarily where you get the signal of where the impulse is coming, because this was not a wage shock. This was an imported inflation shock and a domestic energy shock, because of a shock in world energy markets, as well as global demand coming from excess monetary and fiscal stimulus. So there are a lot of things happening at the same time, but really the bank was too slow and I think too timid in raising rates. My view is always to look at what the rate should be today, not how much should we change it. And we're a long way from where we should be today.
What do you think it should be? I mean, I think we're around 3.6% now. The US is around 5%.
Yeah, that's right. So my rule of thumb is, what is productivity growth in the economy? Let's say it's 1%. What is the inflation target? Let's say it's 2 to 3%. Then a neutral monetary policy would be an interest rate of around 4%. Okay. We need interest rates above neutral to bring inflation down. So you're probably talking 4.5% at least, maybe 4.75, to be effectively tightening monetary policy.
Wow.
And right now, we're actually got loose monetary policy.
Okay, I want to ask you a couple of things about this. Firstly, if you say the RBA was too timid and slow to raise rates last year, what's your assessment of the Governor Philip Lowe's performance?
Well, I think he's done a great job over the years. I think that was one. There was two problems, I think, and again, it's easy to criticise in hindsight, but one is communication. I think the banks should have been very careful in the way they used what they call unconventional monetary policy. These are where you promise interest rates aren't going to rise for a long period of time.
Exactly, that was so misleading.
Lots of central banks used that in their toolkit. They tried to convince people that they weren't going to tighten policy to suggest people should go out and spend. All the central banks did this. The problem was that I think the governor was a bit too specific in the timing of when rates would go up again. And I think that was just miscommunication. I think the second issue is what should interest rates be? And I would disagree with where we are on interest rates right now.
Yeah.
But again, I could very well be wrong. We could have a shock come along where this is the right level of interest rates. I just haven't seen the shock yet.
This is what I want to ask you. You know, if you say that the interest rates should be closer to 5% or, 4.7%, then aren't you worried about the financial turmoil we could be thrown in, GFC-style contagion? We've already seen the collapse of Silicon Valley Bank, the acquisition of Credit Suisse. I know banks are stable in Australia, but there are non-bank lenders, there are managed funds that aren't as tightly and closely regulated. I mean, APRA, you can debate whether or not it's really got very strong oversight. So what do you think about that?
So, Sharri, that's a really good question because I was on the board during the global financial crisis. This is quite a different crisis to that. Nobody knew when the market started to collapse in the US, just where all the assets were being held, where the liabilities were. It was a complete confusion. We have had a decade to get the regulations right in many countries, although the US has backtracked under President Trump. The point is that the Silicon Valley Bank was quite a unique failure. They had long-term government bonds on their balance sheet. They had a massive inflow of deposits, and the interest rates went up, and they hadn't hedged it, which meant that they basically went belly up. The other spillovers, which is where the problem is a contagion.
Yes.
Now, the problem with contagion is you might have a very healthy bank and people pull their money out. That bank is no longer healthy, and the policymakers have to make a judgment. Is the bank illiquid or insolvent? In many cases, under current circumstances, you'd have to guess they're mostly illiquid. When it comes to Credit Suisse, they were probably insolvent, but they've been going down for several years, and so that's not necessarily a related incident.
Yeah, Warwick, McKibbin, we are completely out of time, but I really enjoyed that conversation.
Sorry.
I'd love to have you on the show again to talk about this as, the situation in the banks globally continues to unfold. Thanks for your time.